So today's video, I'm going to be covering how I research my stocks. I'm going to cover everything from looking at the valuation of the company, looking at the company profile, understanding what it does, looking at the financial statements, which includes the income statement, balance sheet, cash flow statement, which is going to show you about the performance of the company, how well it's doing, and I'm also going to cover the valuation of the company with the dividend profile to see how the company is paying out to investors. So my name is Yaro here, and before I get into it, just make sure you smash the like button, hit the subscribe and notification bell. It helps my channel huge, and let's get into it. So I'm gonna show you guys how I do my research on stocks, the process I go through, and it's gonna be an in-depth video, so you wanna watch through the end because every part of this process is very important. The first thing I wanna do is look at the company's profile. It's also, I just wanna mention that it's a lot easier to research a stock when you know what the company is doing. Like Johnson & Johnson, I know they sell healthcare products, medical supplies, and prescription drugs. So I go on Seeking Alpha. Recently I've been using this platform because I like the way they present things, but the company profile will tell you what the company does. It researches and develops, manufactures, sells various products in healthcare field worldwide. You can see a lot of these products in the pharmacy stores, at Walmart, at Targets. So you know what this company does because you use these products on a daily basis. So once you get to know what the company does, the next thing I want to do is take a quick look at the performance of the stock. And I don't look at the performance of the stock in a day or 5 days or a month or 6 months. I like to look at it a year plus. So I look at it a year, look at Johnson & Johnson, it's up 2.41%, which is not bad because considering everything that's going on right now, the stock price is staying up pretty high. In 5 years is 44% return on just the stock price alone. 10 years 143%, and you could look at max if you want. And look at this, looking at this stock chart, you could tell that this company has been doing well, and that's just a preview to seeing the rest of the research that I do. So now once you understand what the company does and looking at the general picture of where the company is heading on the stock price, will kind of tell you the valuation of the company and whatnot. So I usually like to go to Finviz, and on Finviz I like to look at the company's valuation, such as price to earnings ratio. So on here it shows you the price to earnings ratio is $22.37 per dollar earned. So the price to earnings ratio is the price of the stock divided by the earnings per share. So if a company makes $1 in earnings profit, you're paying $22 for that $1. So I think that usually a company that's got a PE ratio of 1 to 10 is usually pretty cheap. And again, PE ratios are going to vary greatly based on industry and company types. So tech stocks are usually going to have higher valuations because they're faster growing, so you pay more for now because in the future they're going to have a lot higher earnings. They're going to grow really fast. So 1 to 10 is usually a sign that the stock is really cheap. 15 to 20 is reasonably priced, and something over 30 is a sign usually that the company is a little pricey, and that's when you see like tech stocks. They're pricey but they grow fast, so you're looking at the forward ratio. The forward ratio is going to be a lot less than the current PE ratio. So once you kind of see the PE, the next thing I like to do is look at the financials. So looking at the financials, you can see how the company has been doing in the past 5 years. So if you get the pro version of Seeking Alpha, you can see for 10 years, but I don't have the pro version. I'm just doing this on a free version. So you could see the total revenues are increasing every single year, and it's kind of indicative of the stock price going up also, and it's a sign that the company is staying relevant, it's growing, and the management is doing a good job managing the operations and growing the company. So I like to look at the gross profit also. I want to see that the cost of revenues are in line with the increase in revenues every single year. So gross profit should also increase every single year, and in this case it does. Look at Johnson & Johnson is a great example of a good company that's growing and staying relevant. Operating income is trending upwards too. So operating income is going to vary sometimes because sometimes companies like to do more investing in research and development to make sure that they are staying relevant and their products are superior to other companies. Now you could look at net income, but I think there is a better indicator than net income to see how the company is doing performance wise. I like to look at the cash flow, which I'm going to cover shortly, but next thing I want to do is just look at the balance sheet. Now looking at the balance sheet, I don't really care about the previous years. I usually like to look at the current year on the balance sheet to see how it's currently situated. So you can see I like to look at first the current assets. This is assets that the company is expecting to turn into cash within a year, and Johnson & Johnson has about $45 billion in current assets, and then I like to compare them to current liabilities, and current liabilities are liabilities that the company is going to be paying within the next year. Looking at Johnson & Johnson, they have enough current assets to cover the current liabilities for over a year. So looking at the current ratio, it's 1.3. I like companies that have at least 1 year of current assets to cover the current liabilities, so a ratio of 1.0. I think that's usually a pretty sign of a healthy balance sheet. And I like to see usually the retained earnings increasing every single year, meaning that the company is taking its net income and it's keeping it within the company. It's not going into a deficit. So next thing I want to do is look at the cash flows. The cash flows is going to show you the actual cash expenditures of the company. So there is three parts of the cash flow statement. There is the cash flow from operating activities, there's the cash flow from investing activities, and cash flow from financing activities. So it breaks it down to a more in-depth level than net income does. Net income is a start for cash flow from operating income. So it takes net income and it adds back depreciation and amortization, because that's not a cash expense. It's just reduces your net income, reduces your tax liability. So you could see that it adds back depreciation, amortization, and then all the non-cash adjustments. It will adjust it so you could see cash from operations. In 2016, cash from operations was just shy of $20 billion, and then it went to 18.7 billion, 21 billion, 22 billion, 23 billion. So you can see that the cash from operations has been increasing, meaning that the company is growing and it's producing more cash every single year. And as an investor, that's, I think, is something that you want to be looking for. It's a company that's growing their cash positions every single year. Looking at the investing activities shows you the capital expenditures, the sale of property, cash acquisitions, divestitures, investments in marketable securities, and other investing activities. So you could see that the company is investing in capital expenditures like property, plant, equipment every single year. So you could see usually cash from investing, usually this is a negative, because companies usually invest every single year to continue to make the company relevant. Sometimes it is a positive when they sell equipment, they sell properties, they sell parts of the company. Sometimes you will see a positive cash flow from investing, but usually it's a negative. And also financing activities. This is debt that's issued or repaid, or the dividends paid to the investors. You could see this in the financing activities. I like to look at the last 5 years. So you could see currently the company last year has not been repaying much debt and has not issued much debt, because that's actually a good sign that they don't need debt. Okay, that means the operations are doing healthy, and they've been actually repaying a lot of the debt off. In current 2019, they repaid almost $3 billion of debt, and they also paid out almost $10 billion in dividends. So you can see the total cash from financing on this line, and if you add up all the total cash from operations, total cash from investing, and total cash from financing, you will get the net change in cash. And you can see this is relatively small, so $802 million from a company that's generating billions and billions of dollars. I think that's not a big change in net cash, and that's a pretty good sign that the company is not over leveraging itself. So lastly, what I usually look in my companies is I want to make sure that the company is paying out its investors. So I look at the dividend profile of the company. I like to look at a company that has about 2.5% dividend yield, which Johnson & Johnson is at that target, 2.81%. And it pays out a payout ratio of 52.31% of its earnings. So I think when a company pays out 50 to 60% of its earnings to its investors, it's a sign that the dividend is usually safe, because they still have free cash flow that they can use to invest in operations and support the company when they need to. So the next thing I look for is the 5-year growth rate average. So on average per year, Johnson & Johnson will increase its dividend about 6.32%. I usually look for a company that pays out or has a growth rate of about 6% or more. That means that the dividends are going to increase in value every single year, and it's going to increase at a faster rate than inflation. So that means your dividends are going to be worth more every single year. And if you look at the dividend growth rate, it's been growing its dividend for the past 57 years uninterruptedly, which is, if the company pays out over 50 years of dividend growth, then the company is considered a dividend king. A lot of investors look for companies that are committed to providing payout to the investors and continue to grow the dividend. So Johnson & Johnson is a phenomenal company. This is really rare to see all these amazing signs that the company is staying relevant, it's growing, it's paying out its investors, it's got a great balance sheet. It's really good to find a company like this in your portfolio and hold it long term, because if you look at this visualization of the dividend history, look, if you held this company in 1990, it paid out 3.0362 cents quarterly, okay? And if you held it through this time, it's paying out $1 quarterly. That's an insane growth. This is like the compounding effect, of 6% growing over time. If you held 100 shares and it paid out 3.62 cents, and now it's paying out $1 per share, that's a massive growth. That's only the dividends. That's not including the stock price growth. So if you look at back in 1990s, this company is worth about $12 a share, or in that same period of time is worth $7 a share. Now it's worth $143 a share. So the stock price is increasing because it's an amazing company. It continues to pay out its investors, and it's increasing the dividend every single year. So the stock price is increasing to maintain that yield. So those are the things that I really look for in a company. I usually look at every single one of these factors on every single company I add to my portfolio. Now I want to do a quick look at the portfolio on M1 Finance. Now I've been saying that there's going to be a correction in the market, but that hasn't stopped me from investing. I'm actually investing more frequently. I changed my position to invest $250 every single week instead of $500 every 2 weeks, because I want to make sure that I'm investing and averaging in my cost and increasing my holdings in my position. My current value of the portfolio is $2,380.55. I have earned $19 in dividends, and the market appreciation of the stocks is $78. This was a lot more, but with the correction it has lowered, but I think this is actually a good time to keep buying more. So my slices, my positions are still the same from my last video, so there has not been any changes, except that I started investing $250 every week instead of $500 every 2 weeks. Alright, so if you guys made it this far, I appreciate you watching. It supports my channel big time, and I'm going to be posting another video every single week on Monday to show you my portfolio update. I'm going to be sharing new tips every single week. So thanks for watching. Have a great weekend, guys, and I'll see you next week.